RMDs are one of the most misunderstood and potentially expensive parts of retirement. If you don't understand them, you could pay unnecessary taxes or even penalties. And if you do understand them, you can use them as a powerful part of your retirement income plan. So let's break them down. I'm Cary Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. And today we're diving deep into RMDs, what they are, how they work, and how to plan for them in a smart and tax-efficient way. So what exactly are RMDs? Required minimum distributions are the amount the IRS requires you to withdraw each year from certain retirement accounts once you reach a specific age. So why do they exist? It's very simple, because the IRS wants its cut. If you've been using tax-deferred accounts, the IRS wants to collect the deferred taxes, and they force you to start taking distributions once you reach a certain age so that they can finally get their money. Now, as of 2023, thanks to the Secure 2.0 Act, if you were born between 1951 and 1959, your RMDs start at age 73. If you were born in 1960 or later, they start at age 75. And they apply to traditional IRAs, 401ks and 403bs, simple and SEP IRAs, and inherited IRAs. They do not apply to Roth IRAs while you're still alive. Now, how RMDs are calculated can be tricky and confusing. Each year, the IRS publishes something called the Uniform Lifetime Table. And the way it works is you divide your account balance as of December 31st of the previous year by a factor from this table based on your age. So here's an example. Let's say you're 73 years of age, and your IRA balance was $500,000 as of the last day of the previous year. You check the Uniform Lifetime Table, and it says your IRS factor is 26.5. That means your RMD would equal $500,000 divided by 26.5, which comes out to about $18,868. This is the amount you're required to take as a minimum distribution. Now, what happens if you don't take your RMD or you miss taking it for any reason? The penalty is a stiff 25% of the amount you should have taken on top of any taxes you'll owe. But thankfully, this can be reduced to 10% if it's corrected really quickly. Now, there are some nuances to RMDs that are important to understand. RMD rules differ slightly based on the different types of accounts. So for example, for traditional IRAs, you must take RMDs starting at your required age. But you can also aggregate balances across multiple IRAs and just take your RMD from one IRA account. So, for example, if you have 3 IRAs and the total RMD you need to take is $20,000, you don't have to take RMDs from each individual account, but can just withdraw from one account if you like. Whereas with 401ks, it's different. You cannot aggregate your 401k accounts. You have to take RMDs from each 401k account separately if you have more than one. Also, if you're still working past RMD age and don't own more than 5% of the company that you work for, you can delay RMDs from your current employer's 401k account. These differences are important to know because it might be enough of a reason to roll over any old 401k accounts that you have from past employers into IRAs to make RMDs more simple to calculate and withdraw. Now, what about Roth IRAs and Roth 401ks? This is where many people get tripped up. For Roth IRAs and Roth 401ks, no RMDs are required. So you can just let these accounts continue to grow or take as little or as much out of these accounts as you like. You have full freedom with that. Now, if you inherit an IRA, the rules are totally different. So if you inherit an IRA from someone other than your spouse, you must withdraw all funds by December 31st of the 10th year following the year of death. The only exceptions to this 10-year rule are if the person receiving the inherited IRA is a minor, has a disability, is chronically ill, or is less than 10 years younger than the person who passed away. But this can get pretty complicated. So if you fall into any of those categories, it's best to consult a licensed financial advisor for advice. Additionally, if the person who passed away was old enough that they were subject to RMDs before they passed or the year they passed, and then you inherit a traditional IRA as a non-spouse beneficiary, you have to take RMDs each year and fully drain the account by the 10-year mark. And these RMDs would be based off the IRS Uniform Lifetime Table factor for the age of the person who passed away, not yourself. Now, if you inherit a Roth IRA as a non-spouse beneficiary, this is different. You aren't required to take RMDs or pay taxes on distributions, but you still have to drain the account fully by the 10-year mark. Also, if the beneficiary of the inherited IRA is a trust, the rules are different there too. Now, if you inherit an IRA from a spouse who passes away, you have the option of treating this IRA as your own, and the 10-year rule wouldn't apply in that case. This would classify you as a spousal beneficiary. So it's all a bit tricky and complex. So if you inherit an IRA, it's definitely worth consulting a financial advisor to make sure you have everything straight for your situation. So here's one of the big questions. How are RMDs taxed? Well, in answer to that question, they're taxed as ordinary income. So taking a large RMD can be an issue because it can push you into a higher tax bracket. It can also increase your Medicare premiums. This is referred to as IRMAA, and it can also impact taxation of your Social Security. You can't avoid RMDs, but you can plan ahead. So here are several ways to manage or reduce impact of RMDs. Number one, Roth conversions before RMD age. The way this works is you move money from pre-tax to Roth accounts before age 73. If you do this, you'll pay taxes now, but it can help reduce future RMDs because there's less money in your traditional pre-tax accounts. Just make sure to fully educate yourself on how Roth conversions work and their pros and cons before doing this. Number two, qualified charitable distributions, or QCDs for short. You can donate up to $100,000 a year directly from your IRA to a qualified charity, and this counts towards your RMD, and it's not taxable. This becomes available starting at age 70 and a half and can be a great planning tool. Number three, strategic withdrawals before you reach age 73. You can also draw from IRAs early to smooth out taxes over time. Number four, asset location. You can also look at holding growth assets in your Roth accounts or taxable brokerage accounts and put your more conservative investments in your pre-tax IRAs or 401ks. This helps adjust which accounts grow the most and can lessen RMDs over time. And finally, number five is delaying Social Security. This can help reduce overlapping income pressure, and it's not right for everyone, but it's worth knowing about when it comes to RMDs. Okay, now let's look at a case study. Let's say you have $1 million in a traditional IRA at age 73. Your first RMD is about $37,700. And you also take $42,000 a year in Social Security benefit income. That RMD bumps your total income to $80,000. So you now owe roughly $9,000 in federal taxes, not even thinking with state taxes. And your Medicare premium goes up by about $80 a month due to IRMAA. But what if you had done Roth conversions starting at 60, for example? By 73, let's say you only have $400,000 in your traditional IRA. Your RMD would be equal to about $15,000 now, and your taxable income would only be about $57,000, which would help you to stay in a lower tax bracket. So this is where planning early can save you tens of thousands of dollars over your retirement. RMDs aren't something to fear. They're something to plan for. Whether you're 60 or you're already taking them, there are strategies to reduce your tax bill, simplify your income plan, and stay in control of your retirement. And as always, if you want help creating a custom RMD plan or exploring Roth conversions for you, feel free to visit us at greenerafinancial.com or reach out to me at any time. I'm always happy to help if I can. Thanks for watching, and I'll see you next time.